first and most important element of an account opening and acquiring a new customer is the experience that we give them. And the most important experience they are looking at is a fast, adequate disbursal and an approval to what the loan amount is. And that is where not only looking at the credit agency ratings, but we have also started looking at big data. That is looking at all the data available of the customer in the market. So for example, when I say in the market, we are also looking at the social footprint of a customer. That is from Facebook, LinkedIn, Twitter and other related accounts. Looking at the profile of the customer in terms of where they are working and what business they are doing. Taking that data, processing it and creating a predictive analysis besides the credit agency rating also, that how this customer is and what are the likelihoods of payback to the organization. Taking that data, processing it maybe within an hour or so is the main objective, and then lending to the customer within the next couple of hours becomes the second objective. Once we are able to play that, then the customer engagement as well as customer appreciation for our brand increases drastically. And that helps us evaluate the customer and close the account as quickly as we can. I would say about 99% of our work is online. 1% which is mandated by regulation, which is the power of attorney, happens to be a physical paper based. But from opening an account, that is digital KYC of a customer, where we are attached with Aadhaar. By pulling in the Aadhaar number and then doing an OTP or biometric verification, we open an account within 15 to 20 minutes. The new customer is able to take the disbursement or even trade in our broking business within 24 hours. And the disbursement of the amount moving from one account to another also occurs within the same period. But as I said, 99% is online. 1% is non-digital, which is the power of attorney, which is a legal sanctity paper. So we need still a signature of a customer. As the old saying goes, change is the only constant. As a company, from being a pure play stockbroking firm and an NBFC organization, we are actually moving more like a technology firm. Technology which is being created in the organization to keep the customer at the center of our universe and the regulator at the center of our universe. All the mundane jobs that no new aged employee wants to take today is being converted into digital space using big data, some form of artificial intelligence, including robo-advisory and so on and so forth for our customer. And that is what helps our customer prosper with us, and the organization becomes more modern and technology driven. The banking business and the NBFC business kind of vary from each other because typically a customer goes to the bank for liabilities and asset products, wherein in the NBFC side, the NBFC sales organization finds a customer and they are catering to do different segments altogether. Now, be it microfinance, SME lending or retail lending, the customer is always looking for funds to be used in productive manner. And having large organizations spread across the country in various tier 1, tier 2 and tier 3 cities brings us very close to the customer. Using technology helps us even get very intimate with the customer, and that is where NBFCs and especially us, which primarily lend in the LAS or loan against shares category, helps us bring customer and service their needs. So big difference in a take would be that banks typically get customers walking to them, NBFCs go to the customer. That is a big differential between the two of us. The quick response to that would be credit score is important. At the same time, I may not necessarily want to give it more than a quartile percentage as a weightage. There are a lot more other information. For example, where does the person work who's looking for a payday loan as an example? If he's working for one of the IT companies, has a long-term job prospect, is a permanent employee and is looking for a short-term loan of 15-20 days, and what is the purpose of the loan? In that case, I may only look at the credit score, but also a lot of information that is available on the internet, such as social media and so on and so forth. In the other hand, if I'm looking at a steady state businessman who's running a business and is looking for a small to medium enterprises loan, a business loan as we typically call it, in such a scenario, credit score of the individual as well as the company may have about 3/4 of a weightage, 3 quartiles of a weightage that I would look at. And in such a scenario, I may not necessarily look at all the social parameters that we spoke about earlier. So our belief as an organization is that the information that is available on the internet about a retail customer is more paramount than only the credit scores. We have heard a lot of stories where a credit score of a certain retail customer or particular retail customers have gone vary because of certain things that would have happened way beyond in the past. So that information is necessary but may not be the decision maker in terms of our lending parameters. Many NBFCs are today trying to become fintech organizations themselves. That is the metamorphosis that is happening. Now the difference or the variation here is that many of the older NBFCs have a legacy factor. They have a lot of sunk cost in the older models, which is brick and mortar and so on and so forth. A typical fintech is an NBFC which is more or less very new, young people who are native to the internet rather than migrants as in the legacy companies. So many companies are trying to migrate and become a new age fintech organization and get intimate with the customers by interacting with the customers directly. So this migration from brick and mortar NBFC to fintech is something that is going on right now. The victors today are the new age fintech companies which don't have any legacies right now, but even the older ones are catching up fast.